Okay, good morning and good afternoon now, and welcome. Obviously, we've made it to Friday. So, just as a starting point, the reason we're sort of doing this is a bit of a trial run for us, really, in that we've actually been doing a lot of workshops for founders, mostly sort of educating on the capital raising process. And the reason we wanted to do this was because we wanted to educate on the process for investors as well, because really fundamentally our belief and the reason why we're so invested into this area is that we believe there's a significant role to play in actually simplifying the venture investment process. In fact, the goal that we're really looking for is how do we actually commoditize the capital raising process? And that really sits at the core of our thinking and the way in which we want to add value to the entire ecosystem. So as I go through this, there's two sides to this equation, right? So as an investor, you'll appreciate there's also the company side. So in me hosting this webinar, really what I'm going to be doing is I'm going to be talking about, one, the process for you as an investor. And then secondly, I'm going to be talking about how we're actually helping simplify the process for companies as well. And that's really important to us. So you'll get to understand how we're educating companies on how to sort of, I suppose, navigate the process of raising money, as well as we'll help you understand how other investors are approaching the investment ecosystem. So outcomes for this session is obviously simplifying the venture investment process. We want you to understand what the different investment trends are in the private space, tips to save you time, money, improve efficiency. That's obviously a sort of goal at our core. And also how we're educating founders, as I mentioned, and the goal and how to get the most out of CRIISP, because it's really interesting. You know, obviously we're passionate about it, we use it a lot, and we know all the different features, but we're also quite aware that people aren't sort of quite, people don't know all the different ways that they can use CRIISP, from their investment side. And even though we've already got, how many people are using it, to me, there's lots of different ways that we can still improve that. So really the topics is what investors want, so what you want, understanding the founders and their journey, because we think that's an important part, how to set up your investor hub on CRIISP. And if you haven't registered on CRIISP already, please do so whilst we're on this webinar. And the reason being is, as I'm showing you the setup process, you'll realize how much easier it can make it for you in your own sort of investments. And also what we highly recommend for companies is that there is a free version of CRIISP, where companies can put up 5 documents into a room and you can still engage. So for your future investment as well, you could recommend companies sort of set that up so that you're sort of streamlining the way in which you actually get access to information. But these are the topics that we're going to be going through. And, a few of these are quite relevant for a lot of people. And what I do encourage is, if you want to ask questions during it, there's a chat. There's a sort of private chat feature in which you can actually send me questions on. So I said, as much as I can help you get value out of this, that's the outcome. Okay, so next one, capital raising myths. Now I like to start off with this because there's 3 different myths that we have for companies that come and talk to us, and also there's 3 different myths for investors. Actually, sorry, there's 2 of them are similar, but there's one that's sort of quite different that you guys know. First one is that it takes 2 to 3 months to raise money. I actually mention this when I do my workshop for founders. The reality is, and I know that from the investor side, you want to understand this, and often you put pressure on companies if they haven't been able to achieve this. But the reality is that it always takes longer than 2 to 3 months to raise money. In fact, what happens often the time is that companies are in a setup phase for a capital raise for anywhere from 6 to 9 months. Building interest, building momentum, building investors, seeding out who they can generate interest from. And then all of a sudden they kick into capital raising mode when they believe that they can get the round done. So, one of the best examples I heard was that a good friend of mine sort of was able to complete a raise in a week. And I was like, how did you do that? I was like, no one else doing it. He goes, oh, actually, and then he said, well, the truth is it actually took a year. To look like you raised capital in 1 week actually took a year of setup. So capital raising does take longer than 2 to 3 months. So appreciate that when you're dealing with the companies that you're looking at. This is an important one for us, and I'll show you this in our survey. But just so you know, even as a high net worth investor, when you're speaking to companies about potential investment, often they have the misconception that just because you're a high net worth, that they'll be looking to put over 500K into their investment. And we know from our own experience that's not accurate, but more than that, we can actually show data as to how inaccurate that is. But I think it's quite relevant for you to know that when you're having conversations with investors that, straight up front, it's worthwhile to sort of highlight how you typically invest in the investment size that you typically invest into companies. So then it's sort of clear and there's no, how can we say it? There's no disproportionate expectations between what you're looking to invest and then what they think you will invest and what you're actually looking to invest. And the last one is that VCs are the main investors. Now, you're probably surprised to actually hear that, given that, for most of it, for most of this space, it's actually driven by high net worths and it's actually driven by sort of family office investment. But from our perspective, it's amazing how many people think that it's just the VCs that actually invest into deals. And we're sort of constantly educating people that that's actually not the case and that it is driven by the high net worth segment and often sort of referrals from high net worths as well. So always looking to encourage on that. Founders' frustrations. I think this is also an important area to kick off with. So what I want to do is I want to go through the founder frustration and then I want to go through your frustrations as well. So the first frustration for founders is typically silence. So what happens is now I've been doing educating, explaining the sort of the reason for the silence and also the reason for the polite nature. But if you think about the typical process, you express interest in a company, you have a look at their information. For whatever reason, you decide that you're not looking to invest. I understand the very polite nature of yourself on the investor side. And you don't often want to formally reject companies for a couple different reasons. One, you're not looking for the counters, and two, you're sort of may just want to watch them over time and see how they perform because you might be interested later down the track. So if you say that, look, I'm not interested or I'm not interested in this round, the thinking might be that they may not approach you for future rounds. But understand that that's a frustration for investors. So communication is helpful with that. This is another one, not declaring upfront if you're going to offer a service. It's important to know that our ecosystem typically wears multiple hats. And on one hat, you may be an investor. On the other hat, you may be a lawyer or an accountant or a corporate advisor or someone sort of typically involved in this area. And what we find really interesting is that, often what can happen is you may approach as an investor and you may decide against it. And then you may offer your different services. Sometimes it's important to note, to the company is that, if you are looking to decline as an investor, to give communication as to why. And if you are going to offer a service sort of following, to give explanation as to why. Because the challenge from our side is that companies get frustrated by this and they think that, they're only asking me questions because, they want to offer me a fee. They want to offer me their service. When we know that that's actually sometimes not the case, in that you did have interest in the business, decided not to invest and thought, you know what, I still like it and I could add value in some other way, and you're sort of offering that. But I think that's important. Showing them another business that you're involved in, that's also can be a frustration for companies. And we hear this many times. Just know that founders want to talk about themselves. They're not so much interested when they're talking to you about investing into their business. That is the clear discussion that they want to have. At that stage, they are not interested in discussing about other opportunities or other potential deals, because the pressure is typically on them to get on the capital raise front. Despite how calm and chilled and everything like that they look, that the pressure is always on the capital raising side. So when they get shown another business or some type of other strategic opportunity, that can be frustrating for founders. And the last one is the not being able to invest because you are going through a capital raise. So we've seen that with different funds. Different funds are in a sort of tricky situation where they want to sort of provide, okay, well, here's the types of businesses that we've got access to whilst they're actually fundraising themselves. But what that means is they can't actually execute on the actual transaction. So typically founders are optimists. So the fact that you've expressed interest in their company and you're asking questions and you're doing some level of DD, they think that there's they've under the expectation that there's going to be an ability to transact. So if you are unable to, because you're going through a transaction yourself, or because there's going to be some sort of time issue, it's important to be clear about that up front, because the founder's brain will just factor that into their thinking, and they'll know that they obviously need to keep on sort of having discussions for their raise. Now, your frustrations as an investor, the first one we've heard about is the time that it takes to receive the information that you're asking for, and also typically the scattered way in which you receive that information. That there's obviously no streamlined approach that's sort of being worked towards from a capital raising perspective. We've heard that that's quite a frustration for investors. Sorry. When the founders are over talkative and communicative, we understand that that's an issue. I know I've heard stories of people being stuck in sort of 3-hour meetings that they didn't want to be in a 3-hour meeting. That's also can be a frustration. And look, as I said, we've listened to these different frustrations, and we've sort of thought about processes to facilitate this. And then the last one is obviously the concern, which is the opposite, sort of is the ongoing communication from founders. So you often hear frustrations from potential investors or existing investors that they're not receiving communications from founders about what's actually happening with the business. So all that sort of stuff is sort of really important and quite common as you're going through the capital raising process. And the last one is not so much frustration, but a bit of annoyance in that sometimes when you're saying no to an opportunity, typically it's in your nature, because you're obviously also an optimist, you want to refer them to someone else. So where do you actually refer those people to? That's typically a sort of thought going through investors' heads. Okay, so on to the next one. Now, just in my day-to-day life, you already would have seen that slide. Typically, what investors want, every time I have an investor event or I'm having a conversation with an investor, they give me a great suggestion that what I should do is that I should introduce them to the good deals. And that's probably what you're thinking as well. And the funniest thing I always reply back is that everyone has their own version of what is good and what is not. And that's why I love marketplaces. So, and that will sort of lead on to the context of what I'm going to be showing afterwards is that, this version of what is a good deal makes no sense to me, right? Said you have your own thesis, you have your own criteria, you have certain things that you're looking for in an opportunity. Our role to play is how do we actually service that from a platform perspective. Next one is that companies always come to us, and this is our frustration. Actually, that's why I should highlight this is our frustration. So companies will say, introduce me to the good investors. And it's like, well, what does a good investor look like? And the reality is that, and I have this conversation with a lot of investors, is that, one person will say someone's a tire kicker, the other person will say that this person is their shareholder, and everyone has different experiences. So the other part I realized that, for example, I could introduce you to a company as an investor, but how do I know that you're going to be interested in them? Right? And how do I know exactly what your specific criteria is? So that's always a dance that we play from the wholesale investor side. And to me, that's why I love platforms, and that's why I love the marketplace approach. Okay, now this part, whilst this isn't relevant directly to you, I think it's important for you to know what is the actual psychological process that a founder goes through. Now, just so you know, I will go through your one from the investor side, but the founder psychological process is an interesting one. And we deal with this on a daily basis, and I'm sure you deal with this from the investor side. But I think it's important for you to understand why, when you're dealing with founders as they're going through a raise, you get these different sort of emotions, and sometimes you sort of don't quite understand. So typically, when a founder starts off a capital raise, this is how they typically kick it off. They are typically overconfident. And the examples I give is that, in our office, we'll have people call into the office, and they'll say, look, we're looking to raise, $3 million, $5 million, and we only want, this type of investor. We want strategic, we want this, we want that. And they've got to be able to put in a minimum check size of 500K. I was like, okay. And for me, as soon as we start hearing that stuff, we know they're at the stage that, and we'll ask questions like, okay, have you raised money before? Have you been through this process before? So typically they start out overconfident, and then what happens is they start to get some rejections, right? And typically what rejection leads to, at some stage, they'll start to feel doubt. And, you know, as far as from a founder, say on the outside, we're always sort of confident about what we're looking to achieve. We do have up days, we do have down days. You're probably very aware of that. But doubt starts to creep into their mind. The next thing that they have, if they keep on getting rejections, is fear, right? And it said it really depends on the day that you're dealing with founders, is which emotion they're currently experiencing. And then as they keep on speaking with investors, typically they'll have one come on board, and then all of a sudden they're back to bulletproof. And the reality is, yes, this can all happen in one day, right? And we've seen it with companies that we work with, right? But just, it's important for you to understand that obviously, you know, as much as the sort of fearless sort of mask is being worn, these are the emotions they're typically cycling through as they go through the capital raising. I use this example, right, because what's frustrating for me is that sometimes you'll have investors and also advisors that make companies feel like they're sort of below or challenged or having issues because they're unable to get a capital raising done within 2 to 3 months' time. And said, after meeting with a lot of investors, they don't actually understand the numbers associated with capital raising as far as how many you have to speak with to have one come on board. So if you think about every investment that you've gone into, the numbers of people that they've had to actually speak to raise that money. So I use this example of Blackbird because these guys, when they went to do this raise, they were some of the most successful guys in the actual ecosystem at that time. Good credentials, high profile, had successful exit behind them, had credibility in the ecosystem. It still took them 500 meetings in 22 months to raise $29 million. Now, obviously it's a different story for them now, but in the first raise, it's important to know that if you break down these numbers, it means they're able to raise capital from 1 in 5 investors, which is actually really impressive. The average investment size was 300K, which is also impressive. And this is the most important part, it took 22 months, right? Now, they're probably not even remembering the other part, but I'm sure it took even longer than that to do. Okay, so this is the job that we're working towards. We consistently thinking, how do we simplify venture investment? And to kick off with, I'm going to talk about the problem that we didn't know we had, right? Because what I know is that the ecosystem is frustrated. And the example I love to use to explain about this frustration is one which typically when I show it brings a smile to people's faces, right? The reason I like to mention Blockbuster is because no one knew that Blockbuster had a problem. In 2004, Blockbuster had 85,000 staff, right? And they had something like 9,000 sites all around the world. So they were massive. And whenever I do live events and I mention about Blockbuster, it's amazing how many smiles come on people's faces, right? Because people actually have good experience. They'd go there on a Friday, a Saturday night, they would get a DVD, they'd wander around, they'd have a look at other different movies, and they had a good experience. But the challenge is markets will always move towards solutions which are efficient. It always moves towards efficiency, which is why when Netflix provided a service, you know, that delivered literally movies at the touch of your finger, right, via mobile devices or via set box, that changed the entire game, right? Because the market moved towards efficiency. Same with the disruption that Uber has been able to do in the taxi area, right? Because you can see that little green icon coming up, and because you can rate, and because you said there's a level of, you know, software and technology associated to it, it's become more efficient from a booking. And the reality is, for me, that someone's in the Sydney CBD, whether I use Uber or whether if I use a taxi, it's because there's literally one right in front of me, because it's more efficient, right? If I'm in other areas, for example, I know they've just recently banned it, but the UK, as a perfect example, I'd be getting Uber absolutely everywhere because it was more efficient, right? So that's why I talk about sometimes there'll be deals that you don't invest into because the founders weren't efficient enough in giving you the information that you're after, right? Or it took them too long, or you got distracted, or whatever other reason, you know, it has. You know, there's all sorts of reasons why people don't go ahead with deals, and often it's related to time, and often it's related to efficiency. And that's always important to really understand. So the next one is that I want to go through is what are other high net worth investors actually investing into? So this was a recent survey that we did, and this gives you a bit of perspective about how you're, how you're looking to invest. And what's really interesting, you can see right up the top, technology, as a sort of general area, and healthcare is, literally features on top. What was interesting for me was to see how high renewable energy is. Obviously, I expected fintech to be high. AI, financial service, and property is also really high. In fact, at the moment on the website, it's amazing how much interest we're getting for property and fund opportunities. What I really want to highlight in this, if you look at what makes up the ecosystem, is that what is a typical first investment size and what is a typical follow-on investment size? And if you may know this already in your own investing habits, but also it's sort of showing that this is actually quite common. But if you look at in the typical first investment between 0 to 250K, 78% of people fall within that. So when I use the example of companies that come to us and say, oh, look, we only want to have our minimum at 500K, I straight away know that that's knocking out 89% of potential investors that could invest into their opportunity. Because people typically don't invest that much for a first time, right? And especially in private investors. And as you can see, like if you actually put almost the numbers together, the numbers of the private and sophisticated investor and the venture capital sort of almost tallies up to that amount, right? It almost tallies like directly up to that sort of 78%. And it's really important to be observing that, because in that, so in that venture capital will be seed stage investors. And that's typically how much they invest, between 0 to 250. So important to note from that from a first point. But what's really interesting is if you see the investment capacity after the initial investment, you'll see that 14% suddenly becomes 1 to 5 million. So that jumps up from 4% up to 14%. I found that really interesting when we had first observed that in the survey. And also what I found interesting is how many now move from 5 million and above, right? It's amazing how much that increases. So very, very useful for you to know. There's one other thing I'm going to highlight from this I'm just going to give you the numbers in 1 second. The other thing I want to highlight, it's actually not on this slide, but I think is really important, is that what are the top areas that investors are looking to invest at the moment? So pre-IPO is at 48%. I found that interesting. Seed round is at 42%. Listed companies is at 42% as well. And IPOs at 39%. Series A is at 37%. So really interesting to know that pre-IPO and seed are the two areas of most interest for high net worth investors at the moment. All right, so going back to the presentation. Okay, so let's go through the venture investment steps, and as part of this, I'm going to be using CRIISP as the example. So there is obviously a free account set up on CRIISP. If you haven't set up already, I highly recommend that you do that, because it really does help as I'm going through this process that, we've done everything we can to simplify it, and you'll realize how you can actually get the most out of the platform going through it. So it'll only take you a minute. It'll only take you a minute to do. So you can literally do it whilst we're actually on this webinar and whilst I'm talking away. You can literally just go on, sign in with your Google account or sign in with LinkedIn, and then you'll be going straight into the platform, and you can actually just set up an easy account to start with. All right, so the first step, set up your free account. Second step, how we're actually guiding. So as I said, this will be some part I'll be talking about how we're helping companies set up with the process. So we're showing you the deal room setup guidance that we're providing to companies. We'll be talking about, actually, a second, I should be deleting that because that's got no relevance whatsoever. How we're helping companies set up frequently asked questions, because that's also important in this actual process. Because with the frequently asked questions, what I realized was that a lot of people are asking the same questions over and over. So we wanted to create it in such a way where we just simplify it so that really, you don't have to answer this. You're not asking the exact same question that other investors have asked before, and they get answered as part of the process. And now my numbers are out of order. And then next is to get the actual discussion and the presentation process. So how we've actually simplified that. Okay, so now, just as a high level, the outcomes of CRIISP, just so you're clear about what we're looking to do. The first one is that what we do is we provide founders with capital raising education. Then we supply them with defined processes, systems, structures for meetings, and also email templates as well. The reason we do that is so that they don't have to think too much with their communication. What they're more focused on is making sure that they've got providing the right setup in the frequently asked questions in the deal room. So that way it's not wasting your time. Now, the importance of that from our side is if we can provide them with the right processes, you're not going to have to spend hours and hours and hours of doing stuff which is just irrelevant and won't actually lead to an outcome. And then obviously the end-to-end software, capital raising, and then deal matching, and I'll go through each of those. Okay, so the free account setup, you can actually set up however. It's pretty easy it's pretty straightforward. It'd be individual, joint individual, company, trust or super fund, partnership, deceased estate, or an unincorporated body. So you've got the option to choose from that. You typically set up your contact details. This is all fairly straightforward. Okay, and obviously the recommendation to upload your sophisticated investor certificate. So what that means is when you go to make an investment, you've already uploaded your sophisticated investor certificate. It's already available for investors. So when you make that investment, it already shows up, and it means you don't have to supply it down the track. Okay, now this is the next part. So to get to this area, you need to click on the My Hub, the My Investor Hub. Now, when you do that, in clicking on the My Info, the reason this part is so important is because it provides a bit of information about you to the company. When you request access, typically all the company's going to see is a name because their email address didn't supply. They'll see a name and they can actually view your profile. If they can see your profile and they can see that you're relevant to them, it is more likely they'll accept your request to view their deal room, because you've got to understand most companies are sensitive about their deal room, right? Even though for you, you see a lot of information, you see a lot of documents, you probably go into a lot of different data rooms. Founders are always still sensitive about it. So they want to know a bit about you before they actually give you access. So you can see here that I've actually supplied information about me. Obviously, I'm not expecting people to call my mobile as part of this. But then when you're doing that, you can set up this area as well, right? So if you're a venture capital firm, you can put in your details here. Family office, etc. If it's none, it's not really relevant, but the My Profile setup is. That's now also, just to want to note something down here, I forgot to mention it. What we're setting up down the track is the ability for syndication of opportunities. So here you identify whether you're willing to lead an investment round or whether you're willing to follow an investment round. If you're willing to lead, that's fantastic. There's obviously an opportunity we're going to have for you down the track. If you're willing to follow, that's also fantastic, because we'll be creating sort of setup, so this can set up for you to be participating in future opportunities that are being led by investors. Your account setup, said it's fairly easy to do. Name, website, investment benefits, etc. Said all this is part of getting the investor to insert their information so that they know how you are relevant to potentially investing into their company. Right. So once again, if you want to save yourself time and getting access to the information, filling out this is important. Just like you want information about the company, they'll also want some high level information about you. Okay, you can actually set up multiple investment accounts, right? You can actually have, as I said, I've got a wholesale investor one set up here. I've also got a personal setup one. So you can set up a personal investment account, your trust, or whatever different investment account you want to do it from. You can have multiple in the actual platform. Now, also what happens is once you've actually set up your account properly, once you've filled in that Investor Hub area, when you click on the Investor Hub, it will then provide a stream that is relevant to your criteria that you've selected. Okay, so when you've actually in your criteria, right, it provides a stream that's relevant. So when I actually click, for example, on tokenize, you can see that in my preference, it's got 100%. Right, and I missed that on my screenshot, so I'll have to add that to my next presentation. But you can see it's got a preference score of 100%. Now, what's really interesting about that is that then when you click on that view room, right, what will come next will be a high level information, but it's giving you details as to why it's actually relevant to me. So as you can see, it matched my stage, it matched exact sector preference of interest to me. It also matched regions of interest to me, and it also matched the minimum and maximum investment. As we continue building CRIISP, we'll be adding more different elements, more different, I I suppose, information that companies can provide as to their business. And then we'll obviously, and you as an investor will have different elements you can add about what you're looking for. And this will become very effective in the matchmaking part. But the idea from our side is that this investor stream is about providing deal relevance to you and about providing the latest opportunities and so forth. All right. In the deal the way we encourage companies, we encourage them to set up different types of deal rooms. One is just a one with a pitch deck. Typically, we understand with you as high net worth investors, you're just interested typically in the pitch deck room. You just want the high level information. More venture capital groups and corporate groups are looking to get access to the financials and also the DD room as well, right? So we encourage companies to set it up so it's really simplified. And the pitch deck room just simply looks like this, right? So it'll have a folder in there, and then the companies will upload their different documents into that room, right? This is what a DD process looks like, right? So companies have obviously uploaded their due diligence documents into the actual room. Now, in saving you time, the other part is that the frequently asked questions. Now, this has been a big area of focus for us in how we educate companies on raising money, because if they can get their frequently asked questions set up right, then it's important that it will save you a lot of time. In fact, the education we give companies is that the purpose of the FAQs is to help you to get to a fast yes or no. The faster they can help you get to a yes or no, the better it is for the ecosystem, right? And said it's important that we go through them. We go through them before. When you're setting up your meeting, we encourage you as an investor to go through those frequently asked questions before you have your discussion. Okay. Now, this is an example from what I see. So just so you know, the way we've actually structured the FAQ management tool is the questions that clicked on the most actually moved to the top, right? So for example, you can see this is my actual personal, this is my deal room for Wholesale Investor. And obviously we've used Wholesale Investor, we've used CRIISP to raise capital for Wholesale Investor. You can see that when investors are going to my deal room, you can see the different things that they've clicked on as part of the process. Now, the fact that that's moved to the top, it means that you know for an investor, the way the FAQs are structured is that most questions that investors are clicking on move to the actual top of the pile, and that's important, right? Also, it's important for me to understand what's of most interest to investors, but it's also good for you to know as well. Now, step 4 is the discussions. So typically what we recommend with a discussion, so you've asked to see a deal room, you've gone, you've looked at the pitch deck, thought that's really interesting. You've gone through the frequently asked questions, and now the next step is to have a discussion. What we're educating companies is to organize a one-on-one discussion, whether it be via Google Meet or via coffee. The meeting should be for 30 minutes. The structure of that meeting should be very simple and as follows. We recommend that you provide a bit of an introduction about yourself, what you typically invest in. If you have a typical ticket size or investment size that you like to invest in, we encourage that you mention that as well. The reason being that way there's no unrealistic expectations or there's no ambiguity sort of following the meeting if there's interest from your side. And then from there, the founder provides a high level overview on the history and also on the opportunity. And when it's on high level, the reason we encourage them to keep that sort of brief. And then it's over to you. By this stage, you would have gone through the frequently asked questions. And so if you have more questions following on from that, this is your opportunity to go through those questions. And then the following next stage is that the founder is to provide you with any details, any information around those questions that you've asked, right? So you may want to set up a secondary meeting for that to when you get that information. The idea behind this is that, you know, those questions, you really, before an investment or sometimes even after that first discussion, you've got the ability to make an investment decision, or you're going to require a second discussion before making that investment decision. But at least the process is fairly streamlined for when you're having it and you're not worried. The idea from our side is we don't want you to be worried about having a 3-hour-long meeting for a first meeting. The strong objective is to keep it down to 30 minutes. In saying that, if you want to extend the meeting because of your choice and the questions you have, that's a different story. Because obviously in helping you sort of control or in helping the sort of manage the situation, we know sometimes investors want to extend the discussion, right, to continue it. or they want to set a time to spend a lot more time to go into a larger deep dive, right? But the reality is we just want the companies to know and you to know that the recommendation of that 30-minute structure for the first meeting. Just so you know what's coming forward from the CRIISP side, this has been a new addition to the actual platform just over the last few days. We've put this setup in such a way that this matches what you would actually expect from pitch deck. And the reason being for that is that this way we're actually streamlining the way in which they can actually communicate. He's asking, can we have, sorry, I just got asked a question, can we have a separate call? Not sure what you mean by that, but basically, companies, we're not a part of the meeting between an investor and a company. This gets set up between you and them. We just recommend what the structure is. We'll have no involvement in that meeting whatsoever. So there's no need for us to have a separate call. But just going back to this, the structure of the presentations is that we've standardized in such a way that said this matches what you would expect from a pitch deck. So that when you actually go into now this was a new feature, so it won't be overlaid to all the deals that you see in CRIISP at the moment, but over the next month or so, you'll see the companies start to update this, and we give them guidance on what to insert at the different parts. So the idea from our side is if we can streamline the information that you want to get access to straight off the bat, and this also matches with what to expect from a pitch deck, that is really quite important. Okay. So the process for the venture investment: 1, communication; 2, transaction. Okay, so we've gone through the part of the communication process. This part's really important for us. Now, you may not appreciate this, but from a founder's perspective, this is incredibly valuable, right? But I hope as an investor, you start to see the improvement in the communications that you have with the companies on CRIISP and also through WI. So what's going to happen is we are supplying this template to every company that works with us. And basically it's a flow chart so that they understand the process that they should be working with you, right? And this way, if we can help streamline and simplify those communications, you don't have to worry about getting 3-page long emails with 5 different attachments to it that you're never going to look at, nor getting nor having unrealistic expectations about what's to go through the process. So this flowchart, we've provided email templates, tutorials, and a step-by-step as far as how they should go through the process and how they should sort of work with you, right? And how this has been built is by us getting feedback from either side, from both the frustration from investors and also the frustration from companies as well. So I hope over the future, you probably won't get it right now, but I hope going forward over the next sort of 12, 24 months, you'll start to feel like the companies that you deal with from us have really got a streamlined approach into the way in which they operate. Let's say you decide to invest into a company, what's really important is that when you do that transaction, this is what I see from the company standpoint, you'll also have your own investor transaction as well. So you can see this in this case, you can see all the different dates related to the actual deal, when the investor certificate was uploaded, when the application form was done, when payment was done, and also the share certificate as well. All those details are held, are stored online, they're secure, and it's all simplified. So you don't have to go back rustling through emails to provide to your accountant or anything like that. It's all actually done via the platform. Okay, so we've tried to simplify it as much as possible. Now, the next step is, what's the process that you go through as an investor? I think this is really important. And by the way, we do educate companies on this as well. So the first one that you're going through is the loss aversion part. When you first look at opportunity, you're understanding all the different ways that you can lose. Now, money is obviously one, time is another, credibility is another, but then the biggest one that investors are thinking about is opportunity cost. In what else could they have actually invested into? You typically don't want to be the first one in, but also you don't want to miss out. This is very, very common. And I suppose I go through this just to highlight that we're all the same. There's typically a bandwagon effect that goes along with capital raising. So if you have other high net worth friends that go into deals, then you typically want to follow because you don't want to miss out. And also if they've done their DD and want to go in, then there's typically that sort of, investing together or that syndicate mentality that is pretty common with just investing in general. After the bandwagon effect, typically fear of missing out is another emotion that investors go through. And you see this commonly amongst sort of VC-led deals, and you also see it commonly amongst companies when they go to IPO, if they've got sort of strong momentum going into that IPO. We know that and this fits really well with sort of what I talked about before, the reason why investors really like seed opportunities is you're typically looking for that sort of 5x to the 5 times to 10 times increase in your investment. The other thing that you're typically looking for is that when you're investing in pre-IPO opportunities is you're looking for that impending uplift or a potential exit, or both at the same time, right? So we educate companies on this just so they know. And the reason is because what's an area that's sort of hard for us is that around valuation. So we sort of educate founders that you're looking for opportunities which you can get a 5x to 10x uplift. So understand that when they're looking at your valuation, that's what's going through your mind. Assisting investee companies. This is an area that people think about sort of after they make an investment. We recommend that, always providing relevant investor introductions. Even if they're not raising, we highly recommend that you look to do that because it could make a difference down the track. Cash flow is commonly a big issue for small companies, and one of the best ways to support them is to consistently be looking to introduce them to investors. There's a way to do that without sort of putting yourself sort of at risk, and it's just simply just mentioning that, it's basically mentioning you're an investor into a company, but of course they've got to do their own due diligence, they've got to have a look at it, and you're not recommending it for them. It's just, you're an investor. The other one is, this has been really helpful from our shareholders, is relevant service provider introductions. Service providers are a massive expense for growth companies, and frustratingly so. And if you can provide them with great introductions to good services that make a difference, then I said that's absolutely worth its weight in gold. And I said it could be lawyers, it could be accountants, it could be company secretaries, it could be property advisors as far as for leasing opportunities. All that stuff makes a massive difference. It could be auditors, for example. Next one is potential commercial partners. They're always handy for companies. And the last, now I put this as the most important one. You may not think this, but I put this as the most important. But introduce them to me. Obviously, I highlight that because we always want to work with your investee companies, and we like companies that have been investor led because they're always relevant to us and they make a difference, right? So obviously we're typically helping companies with investor profiling, and at some stage down the track, they're going to be raising money. Companies you reject, also typically if you're just because they're not in your criteria, you may have other investors that find these deals relevant. Providing recommendations to those companies is always helpful, right? But obviously you've got to put in your sort of, your verbal disclaimers with that as well. Relevant advisors. Sometimes there's advisors that may be in your network that specialize in that opportunity that you're rejecting to. It's always worth it. If you do like the company, this is obviously like, trust, respect the company, then you may want to introduce them to a relevant advisor. And of course, that last one is, of course, introducing to me as well. So basically, I'm just saying companies which you're not interested in or companies that you invest into, we recommend you introduce them to us because obviously that's how we build our business. That's how we sort of create opportunities for our ecosystem. So utilizing CRIISP for investee companies. So I'll just go through this very quickly, but this is how your investee companies can use us, just so you got reference. There's 4 stages to how we work with companies. 1 is obviously we provide education. 2, we provide software. 3, we provide process, like what I showed you before. That's just one part. And then the other part is obviously we've got access to investors, right? And sort of we're always analyzing, refining, we're improving, and obviously repeating that process. So we think about it in those 4 different stages, and we're just trying to commoditize this process so it's not such a frustration and it's not such a mysterious art to people, and it's just simplified. Our outcome for our education is 1, we want to help companies increase their conversion rate by up to 100%. So for example, to give you some basic numbers, we tell companies that if they're going to speak to 10 to 40 investors, if typically they need to speak to 10 to 40 investors before they get one, if they can improve that by 100%, that makes a massive difference for the companies. If the goal for us is we want to help them reduce their service costs and also reduce the amount of time they spend with investors. So as example, we want you to reduce the amount of time you spend looking at companies to get to your decision, same way the other way. It actually works in their favor as well. The biggest one is that you as an investor will know there's a massive opportunity cost when companies raise money, and it often can impact their revenue. So the objective for us in this streamlined process is that they can actually minimize that by at least up to 50% as well. This is typically what we deal with when companies are raising money. It's called the Dunning-Kruger effect, and this is just important for you to know as it is for us to be aware of. Typically, companies start out at this area. They're confident for no reason whatsoever. And then as they go in the process, they realize how much they don't know. And then only through actually consistent raising money and sort of refining their own processes do they get more improved. So this is part of how we want companies to get to here as a starting point, to realize that it is a challenging area, and it is a process. It's a sales and marketing process, and it just takes time. And this is the other part. We help them understand the expectation versus the reality. This is the expectation that companies have when they go to raise money. This is the reality of what they feel like as they're going through the process. This is all very common and all just part of the journey. The core principles that we work with companies towards is 1, get ready. So obviously what I showed you before. 2, stay ready. 3, always be raising. The reason being, even if not taking money directly into the account, we find that when companies are raising money, it's a great time for them to create strategic opportunities, also to attract new shareholders that can attract new connections to that business as well, can be seriously valuable. And it's just that consistent freshness of bringing into the company. And then get to a yes or no as fast as possible. These are core principles that we build off CRIISP. And also the fundamental underlying is how do we help companies and investors and the ecosystem save time, save money, and improve efficiency? They're the 3 things we're always working towards. Okay, so just to give you an example of what this looks like, just on a basic numbers point of view. So say a company raising $1 million, right? This is typically what it can actually look like. So, they could have an average investor contributing $100. They could have a conversion rate of 10%. So that means they have to speak to 100 investors to get 10. Right? So just think about that as a basic maths. If we can help those companies improve that conversion rate by 50%, that means they'll bring on 5 more investors in that exact same amount of period. So instead of raising $1 million, they're raising 1.5 million. So effectively that additional 500K can make a significant difference to a business, right? Or whatever that amount ends up being. It could be 1 million, could be 2 million, could be 5 million for all you know. However, it's a massive improvement for the company. What's most important is not only the money coming into the company, but effectively it saves them 6 months of raising money, right? Which then obviously lessens the opportunity cost and lessens the revenue impact. So that's sort of at the forefront of our mind. And then also this is what we're really going for as far as we want companies to raise capital with confidence. We want them to use the analytics, we want them to save time, reduce opportunity costs, and actually just use our templates. We don't charge that much for it. We charge $2,388 per year. Most people think that when they see CRIISP that we're going to look to charge sort of 6 to 8% of the capital raising fee. That is, we do not charge success fees or transaction fees. It is a flat service fee per year. That's it. And this is what they receive for that. The reason why I'm telling you this is because we want to be transparent in how we operate and how we actually price, so that you're very clear that there's no additional pricing, or you don't have to go off the system to do a transaction, which we've heard of investors asking. You can do it completely on the system. There's absolutely no additional fees whatsoever. It's just a one-off yearly fee for the company to use the platform. Other features we'll have coming soon. Investor relations will be a next feature we'll have coming, so that companies can communicate with you directly. And this means it really simplifies their process so that they can communicate with you from there. And also the ability for professional service tools, and then secondary sales for your liquidity as well, right? So you can say the way we're obviously being very founder-led in the way we're doing it, but also we're being very investor-led and we're simplifying it. and also so that they can also track exactly how many communications they've sent out to their investor network. And at least they're aiming to send out sort of between 4 to 12 per year. If you haven't registered already, we do have Emergence coming up. We've got over 2,000 attendees registered for that event. It's the largest thing we do each year. There is no better place in Australia or in Australasia to be, whether it be for companies or founders, because for the companies presenting, they will have, you know, and if this is relevant for an investee company, for the companies that are presenting, they will likely get 6 to 12 months worth of investor leads from this one event and this one experience, right? So it can save them a massive amount of time. For you, it's your opportunity to see as many deals as possible in the shortest time frame at the event. So we've got a significant amount of opportunities there. It's a beautiful way to network and deal make and meet the ecosystem. I said literally the entire Australian emerging company ecosystem is coming to that event. So it's an incredible opportunity. These are my details. You can add me on LinkedIn. My email address is obviously there, and the website is CRIISP.io. That's the end of the presentation from my side. If you have any questions, please ask a question in the chat and I will answer. Happy to stay on the webinar for a few minutes to answer any questions you have.